Welcome back, it's me Adam and you are watching Unlimited Options Investing. In this video, we're going to be talking about the most overused word of the year, and we all hate it. It sucks. No one is exempt. We're all feeling the effects from day to day, inflation. And in this video, I want to take an article from Yahoo Finance and we'll go through it together. So before we do, if this is your first time on the channel, welcome aboard. Hit that subscribe button, smash that like button, and as well take a look at my description for links to my Instagram, my Twitter, and my TikTok. So inflation will probably fall, but it won't be the Fed's doing. The Federal Reserve is working hard to bring down inflation, raising interest rates at the fastest pace in nearly 30 years. Recently, some analysts have begun to explore the idea that inflation may moderate in the coming months. But this decline likely won't be due to the efforts of the Powell Fed. It increasingly looks like markets mistook the bullwhip effect of supply chains, including food, for secular inflation. Tom Lee, who is the most renowned bull on the stock market, Fundstrat's head of research, wrote in a note Sunday, "The bullwhip effect describes roughly the tendency of businesses to over or underestimate the amount of inventory they will need relative to consumer demand, resulting in volatility in orders across the supply chain." And the one person that we all know from Wall Street is Cathie Wood, and she's been beating this dead horse for a couple of years now, saying that eventually businesses will have too much inventory and all of a sudden there'll be way more supply than the demand and it will bring prices down. And I believe it was Walmart and Target during their earnings calls saying that was in fact the case. So let's see if there's more of a ripple effect across other businesses. And I believe it was Walmart that said they're going to bring the price down, or roll back the price, as they say, for a lot of their goods. However, when it comes to food, people are still shopping there, so they have no reason to bring down prices for food. And especially right now, a lot more people, or consumers rather, are buying services rather than goods at the moment. In the case of the past year, retailers overestimated, leading to them broadly over-ordering from wholesalers, who then in turn over-ordered from their own suppliers, leading in aggregate to a major mismatch between consumers' actual demand and inventories on hand. The bloated inventory levels at Walmart and Target and Gap's, which is I think the Gap, and other retailers this past earnings season served as a recent example of how this effect played out in real time. I do not believe companies want to permanently carry higher inventory. It is expensive and introduces huge balance sheet risk, Lee said. Thus, companies will want to trim inventories when supply visibility improves. The logical implication for me is prices will come down. This all may sound suspiciously familiar to the Fed's now debunked argument from last year that inflation would prove transitory, which we all know didn't end up being true, which was exacerbated by the war in Ukraine. And the data even earlier this year have disappointed economists looking for a peak, with May's 8.6% CPI print unexpectedly taking out what many had expected would be the peak this year in March, which is why we saw the market, I think it was 2 days in a row after the CPI came out, it gapped down twice in a row. It was a brutal sell-off a couple of weeks ago. Already, however, prices for metals, commodities, and energy, all raw materials in the supply chain, have fallen sharply from recent peaks. West Texas Intermediate crude oil futures are on track to post their first monthly decline since November, and cotton futures have plummeted from a more than decade high logged in May. And this decline may come just in time. As Jim Reed, Deutsche Bank's head of credit strategy and thematic research, illustrates below, the Fed began raising interest rates with inflation significantly higher than we've seen in prior hiking cycles. Over the past 70 years, the first rate hike has come at the median when the Consumer Price Index reached 2.5%. The first hike this year, by contrast, occurred in March when CPI soared at an 8.5% annual clip. The only rate hiking cycle that resembles the current environment began in August of 1980, when the Fed started raising interest rates and inflation running north of 12%. We all know the story of Paul Volcker and what he did raising those interest rates overnight. And a lot of people were really mad at him. He received death threats. There was a deep recession back in the 80s. It wasn't fun, but ultimately people came out better in the long term. Where the cycle is so different is that the first rate hike occurred very late in the inflation cycle, Reed said. My base case remains that the Fed will find it very difficult to ease policy, notably given that inflation is going to be harder to dislodge. And a lot of people are really blaming the Fed for this. Back in 2021 and even early 2022, we were still printing money into the system, where I think after the vaccines came out back in early 2021 and most people had gotten them, I think for at that point, the consensus outside of the Fed was that's okay. We don't need that stimulus anymore, and we can get back to normal life or something that resembles more normalcy. But we just kept going with it until this year, and we're really feeling the effects of it. And again, it's way too late, unfortunately. And although another ramp up in the rate of inflation in June may be in the cards, this does not preclude a deceleration in inflation later this year. June is bound to see another big jump in the headline index thanks to the surge in gas prices in recent weeks, but the abrupt drop in wholesale prices means that retail gas prices are set to fall quite sharply over the next few weeks. Ian Shepherdson, chief economist at Pantheon Macroeconomics, wrote in a note. At the same time, core pressures are starting to moderate, thanks mostly to slower wage growth at the margin, so we would be surprised to see the core CPI keep rising at the recent 0.6% per month pace. Shepherdson said he expects headline CPI to rise 1% in June, but the average at only 0.3% rise over the next few months thereafter, and that would be amazing for the stock market and for markets in general if that were to occur. And what's amazing for the stock market would likely be also amazing for the crypto market, but again, let's not get too ahead of ourselves. And this could give the Fed leeway to slow its pace of tightening by the end of the year, he argued, even as it refuses to budge from its hawkish rhetoric for now. And dare I say, they even bring back QE, quantitative easing. Again, let's see what happens, but it's going to be wild, that's for sure. Policymakers know very well that the path of inflation, especially the core rate, over the remainder of this year is mostly baked in and is impervious to their interest rate decisions. Monetary policy works with long gaps, Shepherdson said. But the Fed has constituencies other than monetary economists. They have to calm the inflation fears of the public, the markets, and politicians. That means they have no choice but to sound as tough as possible because part of their job is to rein in inflation expectations, adding, if inflation then fails faster than their base case forecasts in the markets, then so much the better. And honestly, the Fed has lost a lot of credibility. They have backpedaled on a lot of things they've said. For example, again, inflation is transitory, and eventually they said, okay, never mind, it's not. They said that we aren't expecting a 0.75% increase in rates, and then what happened? They just did it last month. They also said that they aren't expecting a recession, and that a soft landing shouldn't be, or a soft-ish landing should happen. All of a sudden, they're saying that a soft landing won't be as easy as they thought. So it's kind of murky out there. But let me know, guys, what do you guys think? Is inflation bound to come down? And if so, when is it going to happen? And at what point will the markets like what they hear and rebound? Let me know in the comments below. As always, like, share the video, subscribe, and check out the links below again for Instagram, TikTok, and Twitter. I will see you guys in my next video.